Good evening, ladies and gentlemen, and thank you for being with me at this Danielcode webinar this evening. My name is John Needham. I'll be your host for this event, and I do apologize for the delay, fortunately, of just a couple of minutes. Mickey D is with us, and it's good to see you here, mate. Thank you. I'm glad that you can hear me. Everything seems to be working well. Okay, well, we've got a whole lot of stuff to talk to you about today, so let's get on with it. This good-looking guy with the straw hat on, a boater it used to be called, is the great Jesse Livermore. So for those of you who were asking the question, Jesse who, and who is he, and what are we saving him from? Well, what we are doing, Jesse Livermore, I'm going to tell you a bit about his story. One of the greatest and most famous stock traders of all time, and a legend in his own time. And he always appealed to me. There's, a whole number of heroes in the annals of stock trading and futures and what have you, and Forex. But Jesse was the one that always appealed to me most. So he was a character and a half. And he doesn't look it in the photo, but he was, I can tell you, a very close relative to a wild man. And he was a punter, a plunger he was called back in the day, the boy plunger. Anyway, let us move on and show you the story of Jesse. And how we can save him, because he finished up in error a number of times. So we'll see what we can do for him. So here we know, folks, markets are rational, orderly, and sometimes predictable. If you understand the Danielcode, they are very orderly and quite wonderful. So these quotes on Jesse are from Wikipedia. And they're not necessarily in the correct order, but there's a book written about him which is still in print. It's called Reminiscences of a Stock Operator, and by Edwin Lefèvre. I'm sure you can get it. I had it. I don't know. I've moved house a number of times over the years, and I don't know where it is at the moment. But it's a wonderful read. It's an unofficial biography, if you like. He was the character that this whole story was based on. And it's true. All of this material is publicly available. It was reported in newspapers at the time, and what have you. So he featured in some amazing events. He took a huge short position the day before the San Francisco earthquake. And he took a lot of short positions in railways and made an absolute killing. And he built up a very large position short before the great Wall Street crash of 1929. And he starts off that he was nicknamed the boy plunger. He went and got himself a job working in a bucket shop at about the age of 14. He was one of the chalk boys who didn't have ticker tapes in those days. You had to write up all the quotes by hand, which he did for a while. And he had his first trade at the age of 14. And he was a board boy posting stock quotes at the Boston branch of Payne Weber stockbrokers, who are still around and pretty prominent with us today. So here he is. He's in there trading. You can read most of the stuff yourself. And these were the days of bucket shops. There was no regulation, or almost none. Persuasion was the only form of regulation which some very influential people used to try to limit the damage that Jesse did to markets. And you'll read that as we go along. So here he is, and then he moves on. He's got one bucket shop that still lets him trade, and he had a huge punt on Northern Pacific Railway. He turned 10,000 into 500,000. Remember when this is. This is back at the turn of the century. This is 1900, 1902 for I mean, $500,000 in 1901 was the king's ransom, wasn't it? Anyway, as I told you in the previous slide, he got short Union Pacific Railroad the day before the San Francisco earthquake. $250,000 profit from that. This just shows you what an influential trader he was, and the size of his trades. His massive short position made him $1 million in a single day. His mentor, J.P. Morgan, who bailed out the entire New York Stock Exchange during the crash, requested him personally to refrain from further short selling. Jesse agreed and instead profited from the rebound. So this was pretty high-level stuff. And in fact, he has a further, even higher-level appointment. He cornered the market in cotton secretly, and eventually President Woodrow Wilson, the President of the United States, and the Secretary of Agriculture asked him to the White House for discussion and asked him to stop he had the market cornered particularly and brilliantly, and he agreed to that, and he said he'll just satisfied to get out at break even, which he did. So he had a big profit on that, don't worry. But when asked why he had cornered the cotton market, Livermore replied, "To see if I could, Mr. President." That seems as good a reason to me as anything else. As you can see, though, this volatility was a massive trade, a massive long and short positions, and huge volatility back in those days, some historic events. He was, by the spring of 1929, he was down over $6 million on paper. This is 1929. $6 million was, I don't know if it was the national debt, was pretty close to it. He made $100 million on the crash there. And a series of newspaper articles called him the Great Bear of Wall Street. And of course, eventually it all catches up. And the creation of the U.S. Securities and Exchange Commission in 1934, once they started imposing rules, including margin, that affected his trading very adversely. So here's Jesse as a young man. I'm going to show you quite a number of his quotes and give you a bit of flavor about him. Here he is: "To anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate." That's what we do, folks. We're speculators. I like this one: "The pockets change, the suckers change, the stocks change, but Wall Street never changes because human nature never changes." Although most of the summaries about him that you read, websites, Wikipedia, etc., they focus on his more sudden and violent short-term trading, at which he was absolutely brilliant. But himself, he never thought that was terribly important. He goes on continually to say, "It's not the thinking that makes the money, it's sitting and waiting that makes the money." He goes on to say, "Another lesson I learned early is there is nothing new on Wall Street." Here we are, although it repeats, its patterns repeat. And he said, although time, people have basically acted and reacted the same way as a result of greed, fear, ignorance, and hope, that is why the numerical formations and patterns recur on a constant basis. Jesse, of course, was a super diligent student of the markets. He was a hard-working man, and he got there. Remember, this guy's a trader. He did it all on his own with his own money. Here's the basis of Flip Me, which I hope you all understand. If you don't, send me an email, please. It's a very, very important procedure in our trading. And here's Jesse saying the same thing. The only thing to do when a person is wrong is to be right by ceasing to be wrong. And that's what our Flip Me Trades work about. Here we are. And this one particularly appealed to me. The game taught me the game, and it didn't spare the rod while teaching. 30 years ago, I became enamored, indeed besotted, about futures trading. And I spent a number of years going to all the big names, all the great names in trading who were teaching, mainly in the United States, a couple in Europe. And I met them all, and I like them all. They're all nice people. They're all absolutely credentialed. It's not make-believe. These guys have been famous at trading in their time. But for me, it never quite worked, whether they were not great teachers or whether I was just stupid, which I think is the highly probable result. The equity curve never built up. It was win some, lose some, win some, lose some. And that was not what I was trying to achieve. So eventually I got to the state. I still had my law practice in North Sydney at the time. And I said to my wife, you know, I'm spending so much time and effort on this trading. I've got to really find out for myself what makes markets turn, or else I've got to, you know, give this away in fairness to my partners and get on with practicing the law. What I did is I sat there in front of my computer for 3 months. I packed up all of the paraphernalia I'd collected from all these wonderful gurus all around the world, mainly in the States. Books, charts, all sorts of GAN stuff, goodness. And I put it all in a garage. I had to rent an extra garage. I didn't have enough garages at the time. And I sat there and I just looked at the charts for 3 months with my head on my hands. And I did that for so long. I finished up with very painful bony spurs on both of my elbows. And it's really exactly as he said here. The game taught me the game. And it didn't spare the rod while it was teaching. Eventually, that's what forced me to go and search for the Danielcode. And eventually, I found the beginning of the Danielcode. I found a thread. And I pulled it, and I was so excited. I ran downstairs to my wife and said, this is it, Eureka, the silver key, as Ceferio would say. I found the key. And, of course, I hadn't. All I'd found was a thread. And when you pull on a thread, you get more thread. And after a while, you've got a lot of thread, and some of it's in knots. And it took me years and years and years to tease out the brilliance of the Danielcode, which is so important to us now. And then he added, there's a time to go long, a time to go short, and a time to go fishing. I love it. Words of wisdom from Jesse. There's only one side of the market. It's not the bull side or the bear side, but the right side. And he mentions there about there's a time to be long, a time to be short. He knew something about time, but not in the way that we do. And here's the final quote I wanted to share with you. It isn't as important to buy as cheap as possible as it is to buy at the right time. And what he was referring to there, Jesse's basic methodology was he'd see a market move in one direction or the other, then he'd wait to see the retracement, and then if that high or low of the initial move was taken out, he'd start loading up. And what he called it was putting out his string. He had a number of different stocks that he wanted to trade, and he gradually put out his string. And of course, his greatest plungers were achieved because he managed to keep it secret. And no reporting in those days, so no limits on stocks or anything else. And had a ton of leverage, wild days, and pretty fanciful. But in his amazing life, here he is. He was married 3 times. He made and lost millions. He was amongst the richest men in the world at one time. But he was a plunger. and he didn't have any idea about risk management, as he says himself. The game was for the excitement, and he couldn't resist it. So he went bankrupt 3 times, and he recovered 3 times, but he didn't survive his 4th great loss. Regulations, rules, and margin beat him in the end. And tragically, he shot himself in November 1940, having lost again this vast fortune that he'd amassed at various stages in his trading. And this is what he didn't know, and this is what you know. If you haven't seen this, go back through some of our earlier webinars this year, and it's all laid out for you in great detail. These are the time cycles. This is the remorseless run and march of time. Time, times, and a half. Time, times, and a half. It goes on again. And Jesse didn't know that. So, as he said, greed, fear, ignorance, and hope. That is why the numerical formations and patterns recur on a constant basis. So Jesse recognized that there were patterns in markets and that they did repeat, because essentially with markets, there are only 3 things they can do. They go up, they go down, or they go sideways. And there's a limit to that. And markets don't repeat, but they rhyme. And you can see these same patterns occurring again and again. But he didn't have his risk management under control at all. It was an all or nothing trading system, and always going for the big hit. And let's have a look at the S&P. Here is the S&P mini chart from its high in April 2022 down to the June 2022 low there. It looks so random, doesn't it? But lots of folks want to trade for longer periods. I'm often asked, can I help them trade for longer periods? Well, absolutely, and I'm going to show you that today. So if you're using Trade Navigator or any other charting software, you will find that there is a tool. When you put your cursor over it, it will say regression line channel best fit. And that's simply a mathematical tool, or geometric tool rather, isn't it? Patterns and designs. And what it's doing is it's trying to fit any pattern at all. And because of that, it's useless. It's the old story, the man who defends everything defends nothing. A market tool that tries to match and meet every pattern is useless to us. But it's a great tool if you add some rules to it. So first of all, change the settings for this tool. You'll see that the default is always 1, standard deviation 1. That's the basic mathematical method, but it doesn't really work very well on stocks. So change that to any of the Danielcode settings or any other number that is harmonic with the Danielcode settings. I run this tool at 1.59, which those of you who have followed Danielcode know is the second number in our sequence after 29.6. The next number is 44, but we want looking for twice that number is 59.3. Very, very strong and dominant in almost all markets. So once you set this tool at 59.3, you can start to put it on charts and see what it does. And when we start here, we start from either a swing low or the closing low. Both are valid. Now this market takes, this particular tool I should say, takes 3 bars to open up. So if the closing high or closing low is available and it is within 1 bar of the swing high or the swing low, you should use the closing high or the closing low before the swing high or swing low, as the case may be. And that's simply that you try to beat the system and get this tool to open up 1 bar earlier. No matter what else you do, don't forget the input. Once we've made the settings as to what we want the constraints to be, after that, it's simply the market bars. As we keep adding days to this tool, it's simply the market bars that create the limits of this tool, which of course we call the Danielcode trading channel. Here with the same bit of chart, we've moved on a bit, and we're running up along the highs pretty nicely, and we have contact with the swing low, and we have switched to 2 channels to allow the correction. That's just one method. This tool, get it out and get used to using it, because it's amazing, but 80% of this is science. The other 20% is art. You need to train your eye. So put it on your chart. See what you can do with it. See what it's telling you. Interestingly, here we've stopped this channel at the correction, but look how the dotted lines, which are the extensions of that channel, look how they hold the low when this market rolls over subsequently. It's absolutely amazing, isn't it? You've got these all of the big push down low after the high, and see how the bar after it jumps straight back up to keep its close above the channel. This is a trading channel here, and what we've done is we've gone on a little bit further, and now you can see that we have contact with the swing low, and we have contact at another point as well. So anything to do with trading channels, they need to have contact with at least 2 parts of the chart. If you're only trying to draw them based on one pivot, they can swing around. There's no stability in them at all, so they're not really telling you anything. Once you ensure that you have 2 bars or contact in 2 different places, and you don't want them right next to each other, think to yourself that you've been asked to build a fence, and it's a 50-acre paddock. So you start off with your corner strainer that goes in, and then you've got to put a sighting peg out. Well, you're not going to put it right next to the strainer, are you? You're going to put it a fair distance out, and another one after that, so you can see the line, and that way you'll build a perfectly straight fence. So that's what we have here. Let's move on. You can see more. We've now moved on from there. Look what I've shown you there, that contact at number 2. As we've added bars, the 1 standard deviation, which is the 2 thick bars closest to the center line, which is a thin blue line. Don't worry if your charts show this differently. Sometimes you might have the thicker blue line in the center and the narrower lines at the outset. It doesn't matter. But what I've done is I've pushed this along 1 bar past when it blew off. It's touching, or it's contact with the second contact, as we've called it. So now there's no contact. That tells you this is not a valid Danielcode channel. And what you have to do is you have to push back 1 or 2 or 3 days to get that channel to work again. Here's the channel, and we've gone back to just 1 bar or 1 channel. You can set the channel. All these tools can have multiples. You can have 2 channels, 3 channels. Those of you who've been with us a while know that I've often show you a long-term chart of T-bonds, which I think topped out at 3 or 4 standard deviations. Might have even been 5 standard deviations from the mean. So this is the tighter version of it, and this is valid. You got the first push up. We have contact with the swing low at the higher of the light blue diagonal lines. We have contact with a very minor first push up. I don't like it. That's the one that's too close to the corner post, if you like, but further on it then gives us second contact as we move up, and it creates a sell signal from there and a buy signal 3 days later. But look what it's done. We've stopped it moving then. So we're right back at that where it says time buy. That's as far as we pushed it. In fact, we end it exactly where it says time sell, the red notification there. But you can see it then turns to dotted lines, and they're just extensions of the range. Look how perfectly this thing is doing. We've stopped it weeks and weeks ago, but the extensions of the line have controlled this market beautifully. You can see from the our time buy signal there, you can see how it rallies up and it goes to that center line, which is the median or the mean. And it goes there exactly, and then it has a counter trend. And it has another attack on that median or mean. It's trying to get back into that channel, and it's corrected again. Eventually, it breaks through that, and it goes up to the top end of the channel, the upper light blue diagonal line, and that is February the 2nd this year. And that bar there, there's a Danielcode TO3 sell signal on that. There's a Danielcode time sell signal on that, and you can see how that develops as we go on. So let's have a look what else we've got here. This is the start of the new downward facing channel. We've fallen out of that major channel, and we're now heading down. So this is the start of a downward facing channel. You've got the swing high and the closing high are both on the same bar. So we have to use that bar. We don't have the option. And as it starts to move out, you can see we're getting support at the lower of the 3 lines and resistance at the high of the 3 lines. And we keep extending that, and we finish up. The early stage of it looks like this. We have contact with the base and the first push down. Again, I point out to you, you need to connect to 2 points. Let's move this along. Move it along, move it along. You don't have a close outside the Danielcode channel. We have a run down that reverses. We have a run up that reverses. The market knows where these limits are, and it's tracking inside them, and it will continue to track inside them as long as this is a valid Danielcode trading channel. And to be honest, once it stops being a Danielcode trading channel, it's pretty much telling us the same thing anyway. So you don't have to be too panicked about it. If you all of a sudden see it's slipped off its support or resistance, you say, oh crikey, I wish I'd done this a couple of days earlier. Doesn't really matter. An invalid Danielcode trading channel, if you've drawn it properly, will tell you pretty much what you want to know anyway. So let's extend this along. Now you can see we have 2 control contact points here. We've lost contact with our setup bar. We might have it at the lower blue line, but it's because it's moved on so far, you can't actually see that. I suspect it does have that contact first, but we have contact on the first push down where I put the icon saying still valid. Little rally from there, and then back down and running down through the channel. Eventually we get to our next buy signal, and you get this immediate 3 bars up, bang, bang, bang. 2 of them very big bars, really fast, savage, quick counter trend, and that's to be expected. This is no longer a valid Danielcode trading channel because we've moved on the extra days and we've lost that contact which we needed. So we must have that contact. Remember, at the time we have lost that contact, the bars you can see at the lows there, they're not even formed at that stage. So we must have that contact, and to do that we have to push it back until we get that contact. So anyway, we've had a rally up out of the channel. Now we've got a new down channel, and it's really fast and really steep. Down, 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 and about 4 bars. 2 bars later, you can see clearly, you see the market, the bar that rallies up to the median, the center dotted line of the 3, and that has a close well up outside the Danielcode trading channel. It's still in the bigger channel, which is not itself valid at the moment, but it's jumped out of the fast down channel. That's telling you had a probable change of trend. Let's move on in here. So then from there, you're going to start your valid upward channel. Left the other ones on there so you can see them at the time they became invalid. So we have a swing low and the closing low of the same bar. We have to start from that. We've got our second contact point as it runs up, and we've got a close outside the channel. It's very hard to see. It was just outside and it's immediately reversed. This thing is not perfect, but for a mechanical system, it's as close to perfect as you could think of. And you can see there, when you look at it on your own chart, we had a little close outside on that outside bar down, immediately reversed. That tells you it's going to try and hang on to the channel. This is the point at which the second contact fails. As we add more lines, more days into this channel, you can see it's lost that link where it said close outside channel immediately reversed. That was giving you second contact point, and in fact the third contact point. We've lost that, and there's a significant comment there saying no contact, I should say, with a really long looping line taking you back into one of the earlier bars. It's almost impossible to see that on the daily chart. I've blown it up with the zoom facility that Trade Navigator have, but it won't allow me to post that for some reason. It'll only post the daily chart. I haven't tried breaking it down into minutes, but take my word for it, it looks like it has contact, but it doesn't. And that, look where this thing fails. Right here, put a cursor on, here it is. Look at this failure here. It's virtually, well, not virtually, it's actually 2 bars from the high. Now, considering you're using a completely manual or mechanical process, that's pretty impressive, I'll tell you. That's a lot better than Jesse was doing because he didn't know about these things. Now, you are going to get, here's the fast moves that this market does occasionally. Sometimes you're going to get these fast moves. Here are 3 of them. And they're so fast that virtually all you can do is, it looks like it hasn't even opened. That's because the closes are in a straight line down. But it's valid, and as soon as you get a close outside that, that particular trend in that chart is over. And now we've moved on to the next channel, which is taking us right up to today. I'm not suggesting that you'd necessarily trade it this way, and I'll show you the reason for that, but you can see that this channel defines the price action in an amazing way. And earlier on, you can see about, let's say, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 17 and 18 and 19, and then 22, you have closes below the bottom line of this channel. They were not there at the time that those bars were being formed. The channel was back quite a bit, and it was deeper on the downside. Nothing closed outside it to the downside. And we got the big break up to the upside. That's fine. You don't have to worry about that. That's just making more money for you. The question is, at what stage would you like to take your profits? Would you have been happy to sit through 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars down? Then a little counter trend at another 5, 6, 7 bars down. Well, for us, remember, we're trading futures. And Jesse was putting on massive leverage, much more than we get in futures contracts. But I don't think I would have wanted to sit through that pullback. So I wanted to show you how you can form and create a workable and safe trading system for the long pull. If you like the idea of this, do let me know. I'll be happy to teach it to you in much more detail. This is what was going on in the meantime. This is exactly the same as the last chart you looked at. And you can see we've just got these, we've just run a 6 cycle through this, a 6 daily cycle. Remember, 6.21 is the vibration of all markets. That's minor time according to the Danielcode lexicon. So I've just run a 6 cycle through all of this. And you can see it's pretty near perfect. It's pretty near perfect, isn't it? Up, down, highs and lows. That's how I trade. And I suggest to you, that's actually a better way of trading than the long pull. But if you want to trade the long pull, what I've shown you so far is a perfectly acceptable and much, much safer way of doing it. Remember, markets weren't regulated back in Jesse's day. He had a whole lot of advantages that are not available to us today, including almost unlimited leverage. Okay, let's move on. I have a lot to talk to you about today. And here we are. This is a Danielcode tutorial. If you want to learn how to do this stuff for yourself, folks, do the tutorial. I've shown you the links there, or go to the website www.thedanielcode.com. The Learn to Trade document link is on the front page, the landing page. Get a free trial. Go and have a look at the forum and particularly look at Greg Palladini's post. And I have not given you a capital P today. Greg, for that I apologize. I started doing this together for you at 3:22 this morning after working till about 8 o'clock last night on it. So I have made a typo. That should be a capital P for a very, very important guy. Okay, so here we are. You can look through all of that and Greg's comments. This was his second tutorial. He did a tutorial in 2016. He came back 2 or 3 years ago to take another tutorial specifically to learn about trading Danielcode time signals, and it's been a life changer for him. And that's what so many of our clients say. The most common comment I get is people say, it changed my life. And it will change your life. It is the most amazing trading system I have ever heard of, seen, or had suggested to me that there's anything better. It's expensive, but finance is available. Let me know what terms you need. Let's do a deal and get you started next week. The sooner you get started, the sooner you're going to be a part of the trading elite. So we've got a few changes coming to members charts. We will this weekend end the coverage of copper in members charts. We'll still create the signals for you, but it won't be one of the members charts, and we're going to replace it with natural gas. Since 2007, which is a long time since we've been open, we've covered copper and silver and gold. So we've been a bit overloaded on metals. Just as I've decided that copper is not a great tool, it absolutely exploded with volatility this week, which is wonderful. But nonetheless, we're going to replace that with natural gas, which, as Greg says, is it can trend, and it's pretty dynamic when it does. But you'll need all your wits about you to trade it. Putting it on a Danielcode members chart will give you great clarity for all of that. I had a comment from one of our clients about the difference between the W2 chart that I use for creating members charts in wheat and the ZW. You would say in the States, you would say ZW. We say ZW, same thing. It's the letter that comes after Y. There's a long story to these charts that have numbers on them. You'll see some of the charts, some of the markets we cover, the grains in particular, UST bonds, they have a number. W2 is the wheat chart. that we use for creating members charts, but you can't trade it. You have to trade the electronic version, which is ZW. So what's the difference? Well, I use charts number 2. These are the old CBOT markets. Even though we're actually trading the electronic, I do all my analysis for you off the combined charts. And this is historic stuff. Many years ago now, CME was trying to take over the Board of Trade, Chicago Board of Trade. There were 2 big exchanges in the States, Chicago Mercantile Exchange and the Chicago Board of Trade. And CME was constantly trying to do a deal with CBOT to take it over. And the brokers didn't like it, particularly the CBOT brokers. And don't forget, these exchanges were owned by brokers effectively. So that's their mastered voice, and one of their great misgivings is they didn't want to change how they quoted the commodities in the markets that they ran. As I say, US T-bonds, US dollar index, all of the grains, etc. And they've got a little arrowhead formation and a number after that. Little arrowhead is properly called a correct. Decimalization has been with us now for 50 years or more, but prior to that, all stocks were quoted on correct. They were quoted in 1/16th, which is half of 1/8, which is why the rule of eighths is important for you. But the CBOT brokers had an absolute affection for the way these markets were quoted, and that was the sticking point with the CME, which is much more modern now. Back in the day, even today, present, big institutions don't trade like we do. They don't get in and out at specific market points as we do. What they do is they decide if they want to take a position, long or short, and they'll put that order through to their broker, and they all trade MOC, which stands for Market on Close. And with all the brokers jostling for position, jostling to get their fills. And remember, these are big orders. These are institutional guys. They're not trading in 1s and 2s. And inevitably, some guys got bad fills, some got better fills. And this caused some complaining and disharmony. And the exchange said, well, we're going to change the way these charts work. And what they did is they came out with 3 charts. They had a number 1 after them, or a number 2, or a number 3. If it had the number 1 after it, it was the old day session only, what used to be called RTH, or regular trading hours, 10 to 4. That was the day session, the main session in those days when we go back. Then if it had a number 2 after it, to avoid the problem that the institutions were causing the brokers by complaining about getting possibly not the best fill, they said what we're going to do is we're going to monitor this market from close minus 20 minutes to close minus 10 minutes. In other words, the last 10 minutes before the last 10 minutes of market trading and the close. And they take that 10-minute period, and as they do today, they'd average all the trading and they'd declare a settlement price, which is what you get on your charts if you've got a 2 after it. And the dash on the right of the bar, that's the declared settlement price by the exchange. The charts that have a number 3 after them are the electronic version. What that has at its close is literally the last trade that goes through a nanosecond before the market closes. So you're talking about day traders. I don't want to be with day traders. In fact, I don't want to be anywhere near day traders. God is with the big battalions, and so are we. I want to be with what the big boys are doing. And those of you who've done Danielcode tutorials know how important the close is in determining current trend. So we want to get the best message out of that. By the way, little note at the end here, folks. Goldman Trader came out today, one of his little missivers, and he said, clients are asking if stocks will hit a new all-time high this year. The answer is yes. That was in zero hedge. Pretty interesting, isn't it? But pretty ridiculous as well. Have a look at it. This market has already retraced over 80% of its loss. This shows you the January 2022 high, shows you the October 22 low, and look where it got to now. We're well past the 75% mark. We're actually at about 80% retracement. Gee, that wasn't too gutsy, was it? But I'll tell you what was gutsy, and I've got to give the guy credit, Frank DB. Those of you who subscribe to his coverage of the fourth seal, you know this. He has been saying since 2022 April, January I should say, January 4, he said that's not the high. It didn't come at the right time. It's not on the right vibration, etc. And he declared right then we would have another all-time high. And he says it's going to be around August. And he actually has a date in mind. So those of you who are interested in that stuff and don't have a subscription to the fourth seal, go ahead and get yourself signed up as quickly as you can. If you have any problems, contact Terry at support@thedanielcode.com. He'll be only too happy to help you. And look at this, 80% already retraced from the low. So, you know, that's what it took for someone at Goldman to get off their backside and say, we think this can make a new all-time high. Momentum is huge, absolutely huge. And the optimism, we've had the greatest bull market in history, folks. That optimism is built in. The vast majority of traders have never seen a proper, real, bitey bear market. As I keep saying, there's never been any violence in this market on the downside. It's moved down, but a very shallow correction, as you saw from previous webinars. Anyway, some other news to update you on. Gold and the US dollar index have reconnected. Remember, I was talking at our last webinar that they were both going the same way, which was down. You can see now that US dollar index is plunging, and I mean plunging, and that's fired gold up, and it's making a half-decent rally. But that inverse correlation of gold up, DX down, or DX up, gold down, has re-established itself. So look at that side of the chart as well. This is a chart of T-bonds, which I've been running all week at the Danielcode website. You can see 1, 2, probably 3, maybe 4 or 5 bars of the recent rundown. There's a Danielcode TO3 buy signal. On that bar you're looking at now at the low, the bottom part of target recognition. We've had this wonderfully important target recognition on 2 of those bars, and we get a lot more. So this is where the market is today. And as you can see, we had target recognition all the way going down there. And that's the market's way of talking to you. Markets are talking to you. They're always talking to you. They always have. The problem is, until we got the Danielcode, we had no way of understanding. We didn't have the language. Now we do. And what this market has been saying to you all the way down into the low and in the rally back up, I know these ratios and I'm tracking them. Have a look what happened today. The close today was actually 126, correct 28. Where's the red line? 126, correct 27. 1 tick difference, not even a human hair. 1 tick shouldn't even be on the map, should it? That is very, very powerful target recognition, as it has been all along. My question is whether that sort of coverage every day, defining the market, where your stops go, what the trend is that of interest to you? If it is, let me know, because I'm thinking of introducing a service for a limited number of markets, which we'll call the Every Bar. It'll have that commentary and positioning every single day. This is sugar, folks, and here are the last two trades. Nice for this market, 3,600 down, 1,500 up so far. Pretty easy money, wasn't it? I didn't get around to putting a heading on this, but that was sugar. This is Aussie US dollar index. I've just lined out a few of these trades to show you how brilliantly well Danielcode is marking these charts. And you can see there's 3,000 up, 2,000 down, another 2,000 up. It's good money, isn't it? Have a look at this. This is New Zealand dollar, Japanese yen. Little 1,300 down from a TO3 sell signal. Rally today, up another 700 in the pool, 2,000 odd in that market. Oil, we had $600 in the first pull along, then got caught by the outside bar, lost a little bit of money, not much, got long again, and where are we today? $4,800. Pretty nice trade. This is the US dollar index, which I told you. This thing is plunging. You can see straight down here from its last TO3 sell signal, $3,100. This is not happening by accident, and it has some serious implications. Here's our friend the Russell. I've been saying to you all year that if you want to trade equities, the Russell is the most rational market at the moment and has the most clear-cut signals. You can see the last three here. This little run started in June the 26th. We had a TO3 plus buy signal into a TO3 sell signal straight down. Got 1.5 bars down. I should have been a bit more aggressive on my stop loss, but I don't. I just trade it the way it comes. Had about 800 in that little pullback, and we're at plus 3,300 on this market today. So there you can see there's $5, $6, $7 odd $1,000 really simply. Remember that turns are really what the Danielcode's about. All trends start and end with a turn, which is why we're obsessed with turns. But by definition, turns are against the apparent trend, so they have a higher probability of failing than continuation signals. So flip me signals are an automatic continuation signal, and they're vital for your trading. If you don't know what flip me is, have a look at some of our recent webinars. They're all posted on the website. There's well over 100 of them now. I don't know how many. An awful lot of them, and you'll learn about flip me, which is really an automatic continuation signal. Very important. Go to chart archives, folks, when you get some time. Every chart that I've created in Forex and futures since late 2007, when the website went public, is posted under our archives. It lives in members' charts for 30 days to give exclusivity to those of you folks who are paying for your subscriptions, and after that it goes to chart archives. Look through it and think. You'll really be hard-pressed to find a market that has turned anywhere except at its Danielcode number, and that's a big deal. That's the basis of what we do. And here we are, we're getting at the end, folks. The business of trading futures and Forex is not to be right. The business of trading is making money. If you haven't already, please go ahead and get yourself a free trial. Just follow the link at the Danielcode website. If you have any trouble, contact Terry at support@thedanielcode.com. If you've already had a free trial, the computer will remember you, the server, I should say, will remember you. I won't want to give you another one, but if you talk to Terry, he'll organize that for you. It's quite simple when you get to know what the problem is. And finally, folks, this is our disclaimer. I've told you many times before, I do want you to read it, and I want you to be really serious about it, because it's so easy to lose money trading when you don't know what you're doing. And it's equally easy to make money when you do know what you're doing. So get yourself educated, and until you are satisfied that you are a better than competent trader, do not risk real money trading. Okay, that's it for today. Let me see what I've got to do here. Here we are. Your screen's up. It's actually very inexpensive relative to learning to trade. Something. This week's DC and time signals in equities elected would have paid off the tutorial and then come some with just one contract. Just nailed the move. That's from Greg Palladini, who is a wonderful Danielcode member. He's been so helpful to all of our new traders on a forum at the Danielcode under I think it's called Danielcode Trading or Training, something like that. Greg has posted his whole experience of the days when he was doing his most recent Danielcode tutorial, and it's wonderful. Been hugely helpful, Greg, to so many of our clients, and we're most grateful to you. And that's fine. That's me for the week, guys. Gig, I hope you're well and on the golf course, my friend. And the rest of you have a wonderful weekend. I'm off the clock now. I placed my orders. It's Friday down under, and you've still got a bit of time to go. So enjoy yourselves. Enjoy the weekend. Any questions you have about trading, do let me know. Do send me an email, jneedham@thedanielcode.com. jneedham@thedanielcode.com. And thank you for being with us today. Bye-bye for now.